Welcome everybody to Hong Kong. If you haven't been here before, obviously a fantastic week for us, and it's our showcase week. So we all get very, very excited about this week. Well, what a way to start the year. Who thought in this room you were all going to be in a reality TV show called The Apprentice? You're fired now has direct meaning for all of us, especially when someone has a bad day on the golf course on the weekend. Since January 20th, countries have begun reassessing the strength of their global trade and security pacts, once the backbone of global alliances and economic trade across cross-border trade and supply routes for 30 years. Industries such as oil, aluminium, steel, cars, wines are now grappling with new tariffs, especially targeting their direct businesses. These policies have introduced volatility. We've seen financial markets. We've seen stock prices down, some as much as 40 to 50% off their highs. Long-term government bonds have dropped and rates are collapsing on expectations of slower growth, and both in the US and globally. The US dollar is stronger, and safe commodities like gold are at their all-time highs, while more consumer-related commodities like orange juices are about 50% off their highs. Oil is being whipped around. However, when we look at the investor and the household surveys, we see uncertainty indexes are back to their highs. We hear the market narrative is tariffs equals inflation, and there's risk of an imminent slowdown, compounded by strengthening US dollar, which is the wrecking ball that imports inflation into all of those other economies. At APA, we think you need to stop listening to the scaremongering market narrative. They are stuck explaining what happened in the fourth quarter of last year. Markets have priced in the Trump trade. CEOs didn't have their heads stuck in the sand. They're actually importing a lot of inventories ahead of this. And so we think it's not exactly correlated that inflation will rise as soon as the tariffs come on. You can see this clearly in the huge trade deficit the US had with China, which is at its all-time records. In fact, when we look at the data, like true inflation, which monitors 18 million prices on a daily basis, what we actually see is inflation is going down and actually creating new lows at the moment. We expect that across the services inflation as well. So it's not clear that Trump's tariffs equal inflation. We're saying focus on the data, not the narrative. The US dollar actually has peaked. Guess what? Just like it did in March 2017 when Trump was in last time. Long bond rates have started to come down, and they act as a key driver of US growth going forward. We now have around 25 central banks looking to ease policy, where we've had very restrictive policy for the last several years. Easy policy has always been a precursor for underlying earnings and improvements in job outlooks, and we expect that in the second half of 2025. Expect a rebound in risk assets. The US dollar will continue drifting lower, and that's key to slowing imported inflation into other economies. The key to this new cycle is a manufacturing renaissance. Indicators like the ISM, so the manufacturing index that we have in the US, has been stuck around 50 now for the last several years, mainly due to the higher pressure of rates. As we move into this global easing cycle, expect manufacturing margins and ultimately earnings to begin to improve. And we look at the best indicators, or the leading indicators that we can see in the markets, Dr. Copper. We can see the copper prices are now starting to trend up, which gives you an indication that companies are expecting higher growth in coming quarters. On the other hand, boards and executive teams are going to have to rethink their supply chains. Do they have the right latency plans in place? Friendshoring was the old trick when we had tariffs in 2017. This time, it's going to have to be tangible onshoring. Now, if we begin to consider beyond Trump, we sense firms are on the verge of materially embracing mega trends in technologies, namely DeFi, AI, robotics, and life sciences, in our rapidly aging population, where we're better able to look after our bodies and minds. These structural trends are seemingly intersecting with the emerging new macro trends of localization. It's creating a lot of headaches, especially if accessing capital and the current banking relationships don't reach that far. We see this onshoring as a major global opportunity for decentralized finance, or DeFi or fintech, driven by new technologies, methods that specifically cater to companies' growth requirements. Now think about the iPhone in 2007. This was a toy. We were hardcore BlackBerry users. People didn't realize what was going to spring up out of the iPhone going forward in new services. But what happened was there was layers upon layers upon layers of new technology. So we end up with GPS, we end up with maps, we end up with identification protocols, and we end up with new payment systems. And lo and behold, today, we can't live without Uber or Uber Eats or the likes, or Alex's online booking system here for our meetings. So this is DeFi in a nutshell. New technology is being laid onto new payment systems, more flexibility around old banking structures. This is what we see all the time at APA, increasingly firms locating their businesses in Africa, Indonesia, Malaysia, while leapfrogging with these payments flexibilities, as opposed to facing the old risk officer who may or may not decide to approve your limits due to their lack of cross-border capabilities. So in a lot of cases, it's just simply ordering inventories or more advanced tooling from other countries. So please don't let this inhibit your strategies. We pointed out this mini renaissance in the manufacturing sector over the next several years. In all economies, the small medium enterprise sector is the backbone of GDP growth. In these types of firms, they faced uphill battles to embrace the large technology scaled solutions. In the past, simple costs, technology increasing complexity, and ongoing implementation and upgrading have been a hindrance for most of these firms. It's now clear AI is the game changer. SMEs can now copy large firms' strategies, tap into their client bases, distribution and servicing models. For example, firms no longer need call centers anymore. They don't need to fill them up with people. AI bots are intelligently answering clients' questions, dealing with client complaints, and accelerating sales engagement. The risk is larger firms are going to be disrupted. SMEs will be the material boost to productivity that we've been looking for many, many years. Beyond AI, the rapidly growing trend is clearly robotics. Companies like Elon Musk's are rapidly shifting focus to robotics, may not even be in the car industry in the future. To date, heavy industry, dangerous industries, logistics have been the key sectors where robotics have had higher penetration. We think this trend is about to broaden out. Robotics will it's clear that in onshoring, the humans will build the factories and robotics will run the factories. And we look into the auto industry for an example. The Mexican wages are about 1/5 of the US, so there is no chance that they can go and move those industries back onshore without embracing the robotics or automation. Unfortunately, in the life science area, I don't have a lot of insights. It's not my area of expertise. But what I have observed is there is obviously aging population that we have to worry about, and we need that workforce to be productive, otherwise we're going to have much, much higher wages going forward. To date, a lot of the life science technology has been about negative screening. So those that know in the mining industry, the construction industry, or the truck delivery industry, it's all about screening for drugs and alcohol so they can satisfy insurance policies. We can see in the US in particular, you can barely find a truck driver now who isn't on drugs. And so they're having real bottlenecks within that part of the industry, and wages are growing up rapidly. But recently, I took a ski trip to Japan, and I got to say, I was completely shocked. This has gone beyond just companies right now. So there was a new Metabo law introduced into Japan in 2008. Now, it's about focusing on identifying on diabetes, heart disease, and associated with abdominal fat. And what we can see is every employer has to assess every employee who's from the age of 40 to 75 on an annual basis and measure their waist. So if you're a man, you've got 85 centimeters, and if you're a lady, you've got 90 centimeters. Now, lucky for us, you're not going to get fired, but it's obviously highly embarrassing, and we're not sure where the Japanese government is going with all of this data. But you can see now life sciences are also going to move into a new domain where we've got this merging between the insurance industry, government interests, and employers. And I think this is the new direction that a lot of firms are going to have to grapple with. Again, technology is driving this. So in summary, don't follow the narrative, follow the data. Trump's moves and changes are already priced into markets. Globalization strategies need to have a rethink. But we think there is a way, as we start to localize in particular, that if you embrace the technology, DeFi, AI, robotics, and life science, you'll have an opportunity to keep up and, in fact, probably discover new markets around the world. And if you are planning to have a long lunch and many drinks in Hong Kong, I'd like to thank you for today, but please make sure you don't add to that 85 centimeters or 90 centimeters waste, because you may not be employed going forward. Thank you very much.